What's going on, everybody? Leo Cannell here with today's Seven Figures Club episode podcast. We've got an amazing entrepreneur on today's podcast for you. Sarry Ibrahim founded financial asset protection after learning about the infinite banking concept. You guys heard about this infinite banking concept? It's very powerful for investors, entrepreneurs, utilizing retirement accounts and insurance. It's a combination. It's very powerful. And Sarry states this about working with clients: it's never an either or situation, it's a both and situation. We want you to integrate the solutions we recommend alongside our business and real estate portfolio to have a double compounding effect. So I know a lot of listeners here, startups, real estate investors, you're building a side hustle and you want to grow your money. If you want to grow your money and do it in a smart way that's protected, there's a lot of uncertainty. You're going to really love this podcast. So let's get ready to rumble.
There are over 32 million businesses in the U.S. and over 90% of them will never break seven figures in annual sales. So how do we as entrepreneurs or aspiring entrepreneurs break into that seven figures club? This podcast will relentlessly share the secrets, strategies, and tactics I've used to create 3 multi-seven figures businesses and bring in even more successful entrepreneurs than me to share their inspirational stories and tactics to success. You can create your dream business and life right now. So buckle up and let's go.
All right, Sarry, so excited to have you on the show here. Tell us a little bit about your background. Now, you're in the Chicago area, is that right?
Yeah, definitely. I'm in Chicago, Illinois. Yep.
Okay, very good. In the Windy City there. And what's your background? You born and raised there in Chicago, or what's your background?
Yeah. Thanks for asking. Yeah, so I grew up in the southwest suburbs of Chicago. It's called Orland Park. Lived there my whole life, and then recently moved 3 years ago. Moved to the north side of Chicago. So I live in the Lincoln Park neighborhood. If you guys are familiar with Chicago, where are you located, Leo?
We're just south of Salt Lake City in American Fork, Utah.
Okay, nice. Yeah, so I'm from Chicago and work out of my home office here, and started a company called Financial Asset Protection, like you mentioned. Started about 5 years ago, and our main focus is using the infinite banking concept, also known as the bank on yourself concept. And it kind of all started, not so much of being so hooked on titles and the way things look, but rather what do they do? And I think that ties in a lot with entrepreneurship, right? It's not so much of the title or the type of entrepreneurship you are, rather the function of what you do and what you do for your clients and what you do for your family. And that's what kind of led me into infinite banking, is that it actually started ironically with a client asking me. I was a Medicare broker, Medicare consultant. So my job was working with people who worked for the city of Chicago, who were like 64, 65 years old, retiring, getting onto their own Medicare plans. I was helping them make that transition. And then one of my clients asked me if I could help him with life insurance. And he said, there's cash value life insurance and it grows over time. And then not rather just focusing on a shiny object, the features of that product, I thought about, okay, why is this client interested in this? He's interested in this because he needs life insurance. He wants it to pay for itself. He also wants liquidity. He wants multiple things to be done with his money. So I decided to look into this infinite banking concept. I came across the book, The Bank on Yourself Revolution by Pamela Yellen. And the book talks about the strategy, the bank on yourself strategy, and how you could, again, back to the functions, what it could do. And I realized a lot of business owners, this would help solve a lot of their problems, the problems of growing retirements and being able to access them. And of course, it could be integrated with other solutions, like how you guys offer access to funding and different areas like that. This could easily be tied into that and could turbocharge different areas of a business. So that's why I want to be on the show. That's why I want to introduce this concept and how we can connect it with different areas of financing.
Very exciting to dive into this. So first off, let's kind of isolate insurance. Let's talk about insurance a little bit. Insurance, you've got term life and whole life and universal and variable universal. So educate the audience a little bit on these insurance types and kind of their functions and how what you guys do sometimes is best for business owners.
Yeah, definitely. And Leo, I apologize about the construction going on right now for the listeners, so I apologize. As far as the different types of insurance, there's typically 3 different types of life insurance. There's term, whole life, and universal. So term is just like how it sounds. There's a set period of time. There's a start date and an end date. Usually 10 years, 20 years, or 30 years, meaning somebody, for example, is 40 years old. They do a 20-year term policy. At age 60, it cancels, it terminates. And if they survive that 20-year period, the insurance company just keeps the money, and that's it. You could renew it for another 20 years if you wanted to, but you would pay a higher rate. There's no equity or there's no cash value in the policy. It's just term only, set period of time, just like you're renting. Whole life, on the other hand, is for your whole life. If somebody, again, is 40 years old, they do a whole life policy. It's good technically until their age 121. So for their whole life. And then obviously the life insurance is permanent. It keeps growing over time. If it's properly structured, it keeps growing over time. And there's cash value. What that means is it's not just whole life insurance. There's also cash value in the policy that's accumulating, that's earning interest and dividends over time, and that's building up. And then you could access that. You could access those funds as they're building up at any time. Universal is pretty much a combination of term and whole life. It was designed usually in around the 80s. So that way insurance companies can compete with mutual funds and banks as far as investment vehicles go. So it was kind of designed as a way to compete with other investment products. And just to be clear, infinite banking is not so much of an investment. It's more of a saving strategy. But universal life is a combination of term and whole life. It is a form of cash value life insurance. I guess the biggest difference between universal and whole life is that it renews every year. That's one difference. And the second difference is that there's some market connection. So you could do, like, for example, an index universal life that's connected to the S&P 500. So as the S&P 500 goes up, it's correlated with that. And as the S&P goes down, it also goes down. But fixed products usually have a floor, like, they'll guarantee you like 2% or 3% every year, and a maximum of like 7%. So that way you're guaranteed to be within that range. The only thing is with universal life, it's very difficult to use universal life policies for infinite banking purposes. So again, it's back to the whole functions thing, is that we're not just buying the titles of the products, we're buying into what they could do for us and how they could help us.
So in what ways, if you're a business owner and you're an entrepreneur and you're looking at these different policies, why would that whole life policy be better? And then I know there's also a lot of different types of whole life policy. So you probably need to help us out understand those. So I'm a business owner trying to, build financial stability. I want to be my own bank. I want to have all the benefits. Why should I go with whole life before I look at maybe universal life?
Yeah, definitely. So if we're looking at some of the problems associated with entrepreneurship or during a business, there's some kind of like different, I would say, overall general steps of problems that business owners face. Like for a lot, and it depends on the size of the business, it depends on the industry, it depends on a lot of other factors. But let's say, for example, in general, one side of one problem is you might have business owners who have trouble making money. They have trouble bringing in new clients, increasing revenue over time. And then as they solve that, so they're solving their marketing problems. Now they're actually getting the client retention. They're getting new clients. Now they're making, extra money. Now they're profitable. Now they're making profits and hopefully multiplying those profits. And then after that, it kind of stretches into a whole new world of problems now. And that is, what do we do with this money that we're saving? How do we reinvest it back into the business? Do we save for our retirement outside of the business? Do we save for retirement? Do we invest in the stock market? What exactly do we do with this money? And the way I think to answer that is, again, it all depends on the clients. It depends on the situations. I say the number one thing to do with that is be able to recycle that money, be able to use those same dollars over and over again without them leaving your pocket. So, and with whole life insurance, if it's properly structured the right way, you could do so. And what I mean by properly structured is that there's a certain there's a couple steps you need to follow to make sure it's the right policy that could address that for your business. So in other words, you're a business owner, you want to figure out ways to retain more capital, retain more profits. You could do so with a whole life policy that is, number one, it has to be whole life. It can't be universal or term. It has to be whole life. Number two, it has to be issued from a mutually owned insurance company. So that means the opposite of a mutually owned insurance company is a stock-owned company. And the difference is, with mutually owned insurance companies, they give their dividends back to the shareholders, to the policy owners, whereas stock-owned companies give their dividends back to the shareholders. So you need to make sure it's a mutually owned company, so that way you can get those dividends back into your pocket. The third difference is something you asked me about before we start recording. This is non-direct recognition versus direct recognition. You want to make sure the policy is non-direct recognition. Let's say, for example, what this means is, let's say you have $100,000 in cash value in the policy, right? That's your cash value in the whole life policy. You go in to borrow $50,000. When you go to borrow that $50,000 from the insurance company, they're going to give you a personal loan of $50,000, leveraging your $100,000 as cash value. You're not deducting from the cash value. That's key right there. You're borrowing against it. Now, people always ask, why do I have to borrow my own money? Well, the reason why you borrow your own money is because while you're using your money, you're borrowing it, your entire $100,000 is earning compound interest as if you've never touched it. So typically, your $100,000 is earning about 5% compound interest every year. And then when you borrow, for example, $50,000 from the insurance company, you're getting it 5% simple interest. So obviously we always want to buy at simple and then earn at compound. Now we're thinking like a bank. We're thinking, how do we leverage money and still be able to keep it growing even when we're using it? And this is where infinite banking comes in. So you have $100,000 here, it's compounding at 5% compound interest, and then you're buying the money at 5% simple interest. And when you do this, an arbitrage happens, meaning that the growth of the money outpaces the cost of the capital. This is non-direct recognition. The insurance company does not recognize that outstanding loan when paying you interest and dividends on your money. The opposite of that would be direct recognition, meaning that the insurance company would stop paying you interest and dividends when you have an outstanding loan. So you need to make sure it's non-direct recognition, because we want to be able as business owners to consistently and constantly use that capital over and over again through borrowing from the policy. And then number 4 is we want to make sure that there's something called a paid up additions rider. This is a part of the policy that helps increase the cash value over time and helps with flexibility. A lot of businesses, maybe they might have different budgets and different goals, different targets for funding policies. So they might say this year we're going to do $10,000 a year, and the next year we're going to do $20,000 for a few years, and then go back down to $10,000 a year. You could do that with the paid up additions rider. It allows flexibility. It also turbocharges the cash value and the life insurance in the policy. So just to kind of recap, whole life, mutually owned, non-direct recognition, and paid up additions. This is the special type of whole life insurance.
This is the holy grail of whole life insurance policy that you want. And I was reading in an investment book, and this is exactly what it was talking about. It was talking about the importance of the non-direct recognition type whole life policy, because the one that's directed, you don't get all the benefits. But if it's non-direct, now you've got the money that's growing. So it's like, if I want to go invest in an apartment building and I've got, the $100,000 for the down payment, well, instead of taking my cash $100,000 and using it as a down payment, I could use it with a life insurance policy like what you're describing. What would the benefits be of doing something like that versus just pulling my cash out of the bank?
Yeah, Leo, that's an awesome question. So kind of like option A is just use cash for that down payment. And then option B is we're going to fund it first in a whole life policy and then borrow against it and then use that for the down payment. So I guess with option A, when you do that, when you use cash, you lose the opportunity cost you could have earned on that cash. If you were just imagine you were earning interest on that money, the day you took that money out and use it for a down payment, you no longer earn interest on that. So you give up that interest in exchange for that down payment. So you're kind of trading cash for something else. Option B, on the other hand, is that when you leverage the cash, you never spend it. Really, you never spend it. You borrow against it. And then you're able now to have almost 100% leverage. So let's say, for example, it was a property that was $100,000. You borrowed $20,000 from your policy to use for the down payment as 20% down, and then 80% of it was financed to the bank. You're using 100% leverage now, but 20% comes from you. Now, what's going to happen is when you're paying back that loan, let's say the property too, it's appreciating. Now the property value is appreciating, and your cash value and the policy are both growing. Had you just gone with option A, you would change that cash just for the down payment on the property. Now you would only have the appreciation on the property now, but not the policy. There's no more cash anymore. So I guess this gives you the ability to constantly grow cash over and over without having to see a dip in it. Also, you don't have to kind of trade it. It's not either, I save cash for the future or I invest it in real estate or my business right now. You could do both. You can kind of keep recycling both. And you'll notice that, eventually you go to banks for your own convenience. You won't need to go to banks because you have to go. Eventually, over time of doing this with experience, with more funding and getting the hang of infinite banking, you'll be able to become your own source of financing, which I guess is key for business owners. And Leo, I want to touch on one thing. Is that for one of the benefits of borrowing from the policy is that you never have to qualify for the loan. So imagine if you're in a situation where you can't qualify for funding, you can go to the policy and the insurance company will guarantee you to loan you out money up to 90% of your cash value. So all you need is cash value in the policy, up to 90% of that. At any time, you can borrow that money. So again, this is really important, especially like in hard times when people lose jobs and things like that. And there's lack of income verification or credit goes down or some things like that happen all the time for business owners. This is a really good place to go to. So you'll never be denied a loan. It's guaranteed liquidity.
Okay. I like that. That's outstanding. So you have this ability to borrow from it. Now, how would it be possible to actually maybe earn a greater return on the money just from what it's growing in the annual compounding interest versus the loan that you take out against it? How would it be possible to maybe even be earning more than what you're paying? Is that dependent upon finding the right mutually, type of whole life insurance company, or do you need to go outside to look for a cheaper loan against your whole life policy? How can you actually, really create some arbitrage where you're making more? And so, for example, let's go to our real estate example, right? I took the $20,000 out of the policy, put it as a down payment, but I did it as a loan against my whole life policy. So I still have the 20 grand in the whole life policy. It's sitting there and it's growing, right? What are the potential interest rates that money could be growing at? And what is it tied to? How is it growing?
Yeah, that's an awesome question. So the way it's growing is that back to the mutually owned insurance company. So as it's sitting so the mutually owned insurance company is a for-profit business. It's a private organization that makes money. And what they're doing is they're taking in premium dollars from all these people and they're pulling it together. And then they're going out and investing about 60% of that pool of money into the bond market and about 40% into private real estate loans. They also give out loans to other lenders. So those lenders can leverage those loans. So there's a lot of banking functions in insurance companies. I guess the difference is that the way they're regulated, insurance companies are super conservative. They actually have to be. They can't invest in super high risk investments. That's why it's mostly in private loans and bonds. And that's how they're able to, a lot of the insurance companies we work with, they've been in business for 150 years, they've been providing dividends and increase in cash values and paying out death claims and giving out policy loans and all these things, all these guarantees over time for over 100 years. So I guess that's really important to understand is imagine you're getting into business with a partner. You want to get into business with somebody who's reliable, who's very conservative and reliable. And then definitely from the funds that you borrow, you could use that for anything you want. And we actually encourage our clients to go out and invest those funds. So that way they could potentially earn higher rates of return, because let's be honest, that the way the policy grows, it's a saving strategy. It's an enhanced saving strategy. It's not so much of an investment. That means you're going to see a conservative rate of return. You're only going to see, 3 to 5%, mostly 5% later on in the years, but typically 3 to 5%. It's not so much of a way where I'm going to put money in and triple it, in the next 5 years. Rather, it's a way that you can use those funds in there to grow it. So I guess to answer your question is, how do we turbocharge that money? I guess the best way to do that is to put it into other high performing assets or investments like real estate. Real estate is really good. Let's say, for example, you put it into rental properties, then you could take the rental income and then use the rental income to pay down the loan. You'll be left now with the real estate property appreciating and the policy both appreciating. As far as the loans, I've seen both ways where clients go to third-party banks and borrow at lower interest rates, again, leveraging their cash value. That's something you could do.
But what are some of those potential interest rates that you would be able to borrow? Just estimating, and I'm sure there's a big range, but what is that range often?
Yeah, from the insurance company, it's typically 5% simple interest from the insurance company. That's the rate right now. It's tied to some bond index. I have to double check which one, but that's how they kind of weigh it out. And obviously,
maybe like LIBOR or something like that.
Yeah, and the 90s, for example, one of the insurance companies I work with in the 90s, they used to charge 10% interest, because obviously interest rates were greater then. Yeah, and then now it's 5%. But here's a cool thing too, is that as a mutually owned insurance company, they make money different ways. They make money from the premiums they take in minus the death benefits they pay out. So that there's a profit there. They make money from the bond market. They make money from private loans. They also make money from policy holder loans. So as you're paying back that policy loan to the insurance company at 5%, that's a source of revenue for them. That's a source of money for them. And when interest rates go up for the insurance company, that means they're making more money. They're charging more for the cost of insurance, for the cost of capital, and then so do their dividends. Their dividends also go up. So sometimes I have clients where we look at the scale. We'll see, all right, in 1990, interest rates were 10%. Fast forward to 2021, they're about 5%. Some clients ask, what if I have an outstanding loan and then interest rates go up next year and the following year, and I have a really big like a 15-year policy loan, which you could do with these policies. What if interest rates go up? And if interest rates go up, so do your dividends. So it's a nice hedge against unexpected market conditions like that, market trends like that, where, if interest rates go up while you have an outstanding loan, then the dividends also go up too. And I can definitely get into taxes too. That's one thing I wanted to talk about too with taxes and infinite banking.
Yeah. So let's look at that example again. Our 20,000. I bought this $100,000 piece of property, and let's say I made 8% on that property, on that cash investment of $20,000. I got some rental income, plus I got to depreciate the property, so I'm winning there. And my 8% return over the next 12 months on that 20,000, ends up being, what is that, $1,600. So I made an 8% return. I'm excited. And let's say my whole life policy, would it be feasible to find a bank or someone where I could get a loan instead of at 5%, at 4%? Or you think that'd be possible? And then what would be an anticipated range of what the policy itself might be earning on an annual basis?
Yeah, awesome. So to answer the first part, definitely you could do that where you borrow maybe at 4% if you can find a better rate. And then the policy itself is growing over time. It's averaging between like 3% and 5% compound every year. So eventually in the later years, you'll see it more towards the 5% growth. And in the beginning years, you'll see it more kind of on the 3% range. I think it's important also for the listeners to understand
so
that
if you were paying 5% interest on the loan and you were only growing at 3%, then you might technically be seeing a decrease in the principal balance if you were having an arbitrage loss of 2%.
Possibly, but the thing is that with the cash value, like for example, in the first couple of years, the cash value is not going to, you can only borrow up to 90% of the cash value, and the cash value is not going to be that great. So I would say, you won't see the positive arbitrage in the first few years. You won't see it. It's a long-term strategy. You usually see it later on in the policy years.
So what's the 90% the maximum loan amount that you can get off of that policy?
Yes, correct.
Gotcha. So if I put like 100,000 in, I've got 100,000. Now, how does that break down typically? And obviously there's a big range in estimate, but if I put 100,000 into a whole life policy, what would my estimated cash value be on that? What would my cost of insurance be, do you think?
Yeah, awesome question. Yeah, so there's different. We work with about 3 different insurance companies. Yeah, and each one has about like 10 different products. So this question could vary. It could be
for sure
different types of products. Like one product that we're working with right now that's actually fascinating, especially right now with a lot of people right now have, like, for example, like EIDL funding and all these other types of government funding they have. So one thing that we've been seeing an uptick in this actually is there's a product that's called a single premium whole life policy. This means that it's just a one-time payment that you put into the policy. So let's say even numbers, you put $100,000 into this policy, you've just paid up the whole policy now. You don't have to make any more payments on the policy. And then you could turn around about 7 business days later and borrow $90,000 from this policy, 10% of that. So this policy actually has no fees. It has no cost of insurance to it. And you could borrow up to $90,000 from this policy. Now, other policies too, they don't work like this. Other policies are going to be more.
Does it have a death benefit as well?
Yeah, of course, it has a death benefit. Yeah.
So if you did 100,000 like that, and now you can borrow 90%. So what does that mean? The cash value is 90%. What would the cash value be?
The cash value would be 100. So premiums going in would be 100,000, one-time payment. Cash value is equal to the first year's premium. So $100,000 in cash value. Loan amount would be $90,000.
Gotcha. So wait, what would if I put 100,000 into that whole life policy, there has to be some insurance cost in there somewhere, right?
Yeah, not with this one specific specific company, specific product. Usually there is. Yeah, you're right. Usually there are fees. There's an insurance expense associated, not fees, but insurance expenses associated. We don't charge any fees. We get paid directly from the insurance companies. So we're not charging fees on top of the helping clients with the cases. But there are, definitely there's insurance expenses. The insurance company has to pay for underwriters, actuaries, they have to pay for the labs, all these different employees and stuff. So they usually policy owners experience the highest fees, or I keep saying fees, insurance expenses in the first few years, probably the first 2 or 3 years. And then after that, they can start seeing kind of a growth pattern in the later years. But to back this one product where you put like the single premium, you can put 90,000 and you have a death benefit too right away. Depending on the person's age, they're putting in 100,000. Their death benefit is probably around $300,000, so about 3 times that.
Wow.
Yeah.
Okay.
Yep. And then this policy will also give you the option to add more money into it, up to 25% of what you put in the first year. So this means if you put 100,000 in, every year after that, you could add up to $25,000 a year into this policy.
Nice. So if you did $1 million, you could put 250,000 in each year. And,
Yep. Yeah.
And that way it's really growing. And now you've got this cash value, and now you are your own bank, right?
Yeah.
So the trick is you just need to be profitable enough in your business that you're putting that money in there,
Mhm.
and you're getting a lot of protection. What's the downside risk on it?
Yeah. Okay. So downside to it is that there's some lack of liquidity, right? Especially if you're putting in $1 million into the policy. First year, you'll be able to borrow $900,000. That this is what the highest liquidity policy is, that a 10% lack of liquidity actually. And mostly this is the best situation, best case scenario. In a lot of other situations, you put in, for example, 10,000 year one, you might have 5,000 in cash value after that, and then it keeps growing. And after that, and usually around year 3, year 4, that's when we start seeing the growth. So I guess the downside is there's a liquidity period or a capitalization period, a period of time where you have to build up the policy. It's not so much of like a fast way to make money. I think it's kind of like, it's also, this connects with also a lot of mindsets too. Like people who buy into infinite banking are typically looking long-term, and they're looking for different ways to use the same dollars. Because, the beginning, we talk about some different problems, like what do we do with this cash? That's one problem. The second problem is, financing. Are we always going to get approved for financing? We don't know that. Even if you are able to get approved for financing, the banks too are not always in a situation to lend out too. So you also want to create a hedge against that, a way for you to always get access to money, even when banks aren't lending out money. And then taxes too. So the growth of these policies grows tax deferred. And then when you take the money out in the later years, typically they are tax-free dollars, even with the gains. So it's something a lot of business owners need to remember, is that, what's your tax liability?
Are they tax-free only after age 65, or at what point are they tax-free?
So in most situations, the policies are always tax-free. The tax-free growth, tax-free withdrawals, tax-free loans, all around they're tax-free. There's no age restrictions like a 401k or IRA. You don't have to wait until age 59 and a half. You could borrow that money or use the money as withdrawals at any time you want in most situations, as long as it's called a non-modified endowment contract. In other words, it's not a modified endowment contract. That's the only time you don't have to pay taxes on this money. So you could literally have money compounding in these policies forever. Pass that on to the next generation, income tax free through the death benefit, and then just keep it in the policies through family banking policies without paying taxes on the growth of these policies or the death benefits.
Outstanding. Yeah, that's amazing stuff. So a lot of tax benefits, you can pull it out. Mm-hmm. And it's compounding, and typically it's compounding at about 3 to 5% on an annual basis. Yeah. And then once it gets rolling a little bit, do you see an increase, or is it typically about that 3 to 5% growth rate? And the bigger thing is your odds of losing part of that principal is pretty low. Is that right?
Yeah. I would say that, comparing to the track record of insurance companies that have been in business, for over 150 years, they've been paying out dividends. Yeah, definitely. It's protected. It's safe. Again, it's a saving strategy, because some people would say, like, there's no such thing as an investment or a risk-free investment. And there isn't really. This is a saving strategy. It's meant to be used for investments. And yeah, definitely there's, so typically when we're putting together the policies, there's typically 2 columns of growth for the policies. One column is the guaranteed side, and the other side is the non-guaranteed side. So guarantees are the insurance company in writing says, for the next 50 years, for example, we're going to pay you X amount of dollars each year, guaranteed. So on this side, it's guaranteed no matter what happens. If, the stock market takes a huge hit, the dollar crashes, everything crashes, we're still going to pay you out this money, in a legal writing, the legal contract. On the other side, the non-guaranteed side is saying, if we have it's going to be the base of it, it's going to be the guarantees plus dividends. So it's going to be like, if we're having a good year, we're going to give you dividends too. So technically, the insurance company, if they're profitable that year, they will distribute those profits amongst the policy owners in the form of dividends that get deposited into the whole life policy, or you can have them as a check paid out to you. So the dividends are not guaranteed. But again, we're only working with a few insurance companies, about 3 of them to be exact. And these insurance companies have a proven track record of paying out dividends year after year, regardless of market conditions.
And so how do these insurance companies make money?
Yeah. So they make money from the actual life insurance part. That's profitable for them. So they take in dollars and then, promise death benefits. But obviously people tend to live for a really long time. So they make money that way. The dollars they hold in versus the dollars they spend at underwriting profit. Number 2, they invest in the bond market. So over time, they're making money that way. Number 3, they're giving out loans to other financial institutions. So for example, Bank of America and Chase, they'll go to an insurance company and borrow like $200 million from them. they actually prefer, they like to go to insurance companies because insurance companies, actually, here's a fun fact, Leo. So I was reading this book, it's called All About Annuities. Yeah. And the author was saying that if you wanted to kind of conceptualize how much cash life insurance companies have, think of it this way. If all the life insurance companies in the United States alone got together and put all their cash in one pile, that pile of cash would be greater than all of the banks in the world, plus all of the oil companies in the world combined together. That's how much cash life insurance companies in the United States have. And it's because of regulatory requirements. They have to have, X amount of dollars per person per in assets under management in reserves. So that kind of gives an idea of how profitable and how much money these insurance companies actually have.
Got you. And they're safely investing most of the time in bonds and maybe some private deals that are with really big companies like a Chase or Bank of America, and it's a pretty safe return on investment there.
Yeah, definitely.
Gotcha. Well, very cool. Well, everybody who's listening to this is probably thinking, wow, this sounds amazing. This is what I need to be doing with my money. It's way better than sitting at the bank doing nothing. And it's actually better and a safer place to have it, because then you can still pull it out as cash in a loan, invest it in your real estate, invest it in your projects, invest in your business, but you still have it there growing and protected. And that's why it's just a better place, obviously, than the bank that's paying you nothing. So how do they take action? How can they connect up with you and your team and look at maybe one of these options, which sounds pretty amazing, to get the tax benefit, the non-directed thing where it's not connected. You can take a loan out without the insurance company penalizing you. What's the next step?
Yeah, so there's two. I recommend for everybody that's interested in this concept, learn about it. Learn as much as you can about it. And I have 2 books I want to give away for free if you reach out to us. If you go to our website, it's finassetprotection.com. There's a bunch of ways to connect there. You can schedule an appointment. You can send me an email. You can connect me on LinkedIn, all from that website, finassetprotection.com. I actually wrote one of those books, so I'll send you both of those books if you reach out. One of them was written by Nelson Nash, the person who invented the godfather of infinite banking, the person who invented infinite banking. And then the other book was written by me. I'll send you both of those copies for free. And just reach out to me and ask me for them. I'll email you them as electronic versions.
Perfect. Amazing. So reach out, guys. It's finassetprotection.com. He's got 2 gifts for you. And more importantly, he's got a safe spot to put your money that's much better than a bank. And you still see, the best part about it is you still get to use it for your investments and to grow up to 90%, which is outstanding. And there really is no other product like this.
Yeah. Thanks, Leo, for having me on. I appreciate it.
Okay. Well, hey, Sarry, you've been an amazing guest and dropped a lot of value bombs. Thanks so much for coming, guys. Once again, finassetprotection.com. And, so it sounds complicated. It's simpler than it actually sounds. And you might have to listen to the episode 2 or 3 times. But if you do, you'll have a really good grasp of how it works. And the bottom line is term life can be good, maybe for some of those big, cheap policies that you need just to protect your family. But if you really want to use your cash smart, you probably need to touch base with Sarry and the financial asset protection team and get that whole life policy. And it sounds like it's a last point, comparing the whole versus the term, or not term, but the universal. Why would you want to go with the whole over the universal?
Yeah,
would there be an instance where maybe universal would be better for somebody, or is whole most oftentimes the better policy?
I think that to better answer the question, it's number one, outline all your objectives, and then let's assume that one of those objectives is to have guaranteed growth in the future. Your whole life could better address that objective than universal life. Universal life, every year it's renewing. So for example, if you do a universal life policy to age 30 there's a rate, and then age 31 there's another rate, and then age 32, and then eventually by the time you're 50 years old, you're paying the highest cost of insurance at age 50 than you were at age 30. So it's the opposite of whole life. Whole life typically has the highest insurance expenses in the first 2 or 3 years, and then after that it kind of tapers down, and you get your money back. There's a break-even point with whole life insurance. You end up getting more of it back every year, and then eventually compounds much greater than what you actually put into it. Universal, it kind of flips the opposite. Universal life companies are notorious for showing exaggerated returns. They'll show you 12%, 13% every year, And a lot of insurance advisors
markets don't grow quite like that. They're not.
Yeah. A lot of insurance companies and advisors got sued because what they would do is, it's like the oldest trick in the book. What you would do is you would just print out an illustration of a universal life company showing you 12% returns. And you would print out an illustration of a whole life company showing you 3%. And you say, pick one. And then everybody's gonna say, I want 12% over 3%. But it's not that simple, actually. There's more to it than that. It's actually the opposite of that. Eventually, there's a lot of times where universal life policies end up collapsing. When you're 50 or 60 years old, they end up collapsing because the cost of insurance outpaces what you're actually putting into it, meaning they become so expensive that you have to cancel the policies.
Well, sounds like you guys want to do a whole policy, but it depends again on your investment objectives and everything. But I think for a lot of business owners, I've certainly heard them talk about this infinite banking concept. Yeah. And Sarry's really got a unique perspective on it. You can tell he's an expert, and you want an expert working with your money. So Sarry, thank you so much for being on the show. And guys, once again, that's finassetprotection.com.
Thank you.
Are you looking for more seven-figure secrets, content, or even how you can launch your own recession-proof business? Then check out sevenfigures.com. That's the digit 7, FIGURES.com, where we share more videos, stories, strategies, funding solutions, entrepreneurial education, and even the secret business type that's recession-proof. Thank you for listening, and if you're finding value in our podcast, please give us a 5-star and invite others to join the club.